No, no.
Welcome back to our channel. Today we're diving deep into one of the most popular tools in technical analysis, the Relative Strength Index, or RSI. Whether you're a beginner or an experienced trader, understanding the RSI can help you make more informed decisions in the market. In this video, we'll cover what the RSI is, how it works, and how you can use it to enhance your trading strategy. The Relative Strength Index is a momentum oscillator developed by J. Wells Wilder in 1978. It measures the speed and change of price movements and is primarily used to identify overbought or oversold conditions in a market. The RSI is represented as a line graph that moves between two extremes, 0 and 100. Overbought level. When the RSI rises above 70, it suggests that the asset may be overbought, signaling a potential reversal or pullback. Oversold level. When the RSI drops below 30, it indicates that the asset may be oversold, suggesting a possible upward correction. Understanding the formula can provide deeper insights into the indicator's behavior. Typically, the RSI is calculated over 14 periods, but traders can adjust this to suit their preferences. Shorter periods make the RSI more sensitive to price changes, while longer periods smooth out fluctuations. Identify overbought and oversold conditions. When the RSI crosses above 70, it could indicate that the asset is overbought and due for a pullback. When the RSI crosses below 30, it might signal that the asset is oversold and ready for a rebound. Spot divergences. Divergences occur when the price movement and RSI move in opposite directions. Bullish divergence. The price makes a lower low, but the RSI makes a higher low, suggesting potential upward momentum. Bearish divergence. The price makes a higher high, but the RSI forms a lower high, indicating possible downward pressure. Use RSI with other indicators. The RSI is most effective when combined with other technical analysis tools like moving averages, trend lines, or Fibonacci retracement levels. This multi-tool approach helps filter out false signals and improve trading accuracy.
3, 2, 1, action!
Adjusting the period. The default 14-period RSI is widely used, but shorter periods, such as 7, or longer ones, like 21, can provide different perspectives. Changing overbought and oversold levels. Instead of the standard 70-30 thresholds, some traders use 80-20 to reduce false signals in volatile markets. RSI swing rejections. A swing rejection occurs when the RSI enters an overbought or oversold zone, exits it, and then reverses direction without re-entering the zone. This can indicate a strong potential reversal. RSI trend lines. Just like price charts, RSI can form trend lines. Breakouts or breakdowns of these trend lines often precede similar movements in price. While the RSI is a powerful tool, it's not without flaws. False signals. In strong trending markets, the RSI can remain overbought or oversold for extended periods without reversing. Lagging indicator. As a lagging indicator, the RSI may not always provide timely signals. The RSI is a versatile and widely used tool that can enhance your trading decisions when used correctly. However, like any technical indicator, it's most effective when combined with other analysis methods and a solid understanding of market conditions. Remember, no indicator guarantees success. It's all about stacking probabilities in your favor. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more trading insights. Share your thoughts or questions about the RSI in the comments below. We'd love to hear from you. Until next time, happy trading.